Now, what I want to do is start a new show, and we'll see how it goes, but I want to start a new show on how I trade options and basically selling calls and puts. I'm going to call it Calls, Puts, and Coffee because I'm going to drink coffee. Here we go. Coffee. It's my nifty Starbucks mug. So let's go ahead and get started. Love the heavy cream. All right, so if you're new to options, this show is probably going to be educational, but I'm not going to start with basics at this point. I'm going to assume you have some rudimentary knowledge of what calls are, what puts are, what it means to buy one, what it means to sell one. But I will go over some of those concepts as we go along. But what I want to do is go ahead and look at some of the trades that I've been putting on. Now, I use a brokerage called Tastyworks because they have a really cool commission schedule. Every options contract is $1 for commissions, and it's free to close. So basically, if you close it, you basically paid 50 cents per contract, 50 cents to buy or to open, and 50 cents to close. So that's really cool. No other brokerage company out there really does anything like that. They'll charge $5 just to even participate and then charge you maybe 60, 70 cents per contract, and that's $5 to open and close. So the commission schedule on Tastyworks makes it really easy. Sorry, someone's calling. Makes it really easy to trade small and trade often, which is their mantra. And I'm usually a guy who trades big and trades weekly. But I'm trying out their style where you trade small contracts, small amounts, diversify across many different positions and underlyings. So let's take a look at what I've done so far in the last few weeks. So a few weeks ago, I opened up what they call a big lizard in Gilead, and I sold 2 contracts of a 70 put. I sold 2 contracts of a 70 call. And then what I did was I bought 2 contracts of a 72.5 call. So basically what this does, and I put this on for, if you can see that, basically 600. So I have 2 contracts here, so that's $3, and you'll see that right here. So $3 for this whole trade. So what that means is, since the width of these strikes, 72 and 72.5, is $2.50, but I put this on for 3, there's no upside risk. So if Gilead shoots through 72.5, I've basically locked in a 50-cent profit. Now, if it goes down, my break even is 70. Oh, nice. We'll go to the Qualcomm in a second. So my break even is 70 minus the $3. So 70 minus 3 would be 67. So I'm showing a profit right now because the underlying Gilead is at 68. So you can see here I received $600 for putting on this trade. And now if I wanted to buy everything back, it would cost me $500. So that's a $100 profit, which you'll see right here. So I made $100 of profit, and I believe I put this on. Let's see if they have the date here. They do not, but I put this on about 2 weeks ago. So what's the risk? The risk is to the downside. So if Gilead ends out under 67, then I can either buy back at a small loss, I can roll forward, or I can just take Gilead's stock and then start selling calls on it. So it would be a covered call, and I would basically lower my cost basis as I go along. So right now I'm showing a $100 profit, and I want to manage this, meaning I want to do something with it, either buy it back or roll it. I want to do that at a 25% profit with a big lizard. So a big lizard is, at the time it was at the money straddle plus a protective call on the upside. So I'm looking at a 16.7 profit, 16% profit right now. So I want to wait for about another 10% there, and then I want to close this, and I actually put it right here. Actually, shooting for the moon here. So if I can close this at a 33% profit today, I'll go ahead and do that. So I put this limit trade there. So if I received $3, and if I can spend $2 to buy it back, that's a 33% profit. All right, so let's look at Qualcomm. Now this is going to be a little confusing. So let me see what happened here. All right, so right now I placed a trade for Qualcomm for April 1st. Or I'm sorry, April 7th. So that's next Friday. All right, so I did another big lizard here. This is a 57.5 put call straddle. So basically it's at the money, and then I bought a protection at 58. And this whole thing cost me, it's confusing. Okay, so I'm a little confused because this is from a previous trade that's going to expire, so I haven't done anything with this. So this throws this off here. But I believe I bought I bought, or not bought it, but I opened it for $1 credits. So basically, if it blows through 58, I've made 50 cents profit. And this is per share, so 50 cents times 100, so $50 profit if it blows through 58. And if it goes down, then I break even at 56.5. So Qualcomm is a stock that I would be okay with owning. I believe they're undervalued, and I mainly trade options on stocks that I would be okay with owning, because if the options trade goes bad and goes against me, then I own a stock that I'm happy with. So something like Netflix, which I can't evaluate at all, or Tesla, these two stocks I think are just massively overpriced, and I would not be happy owning them. So I do not trade options on them, because I would not be able to sleep at night owning those stocks. So now this Qualcomm I'm good with owning, and I would basically own it at 56.5 if it dropped below. So this is a good trade for me. The previous trade I made money on, and I'll have to look and evaluate exactly how much money I made on it. I believe it was $50. Now you go, okay, well, these are such small dollar amounts. But so with Tastyworks, with their dollar commissions, I basically put on these trades for $3, and then I can make $50, $100, $150. So imagine you take $3 and you turn it into $100. Would you do that? And if you do this often enough, then yeah, it's worthwhile. So usually I'll trade options that are $600, $700, $800. But in this case, I'm trying to do the tasty trade method, where you trade small, you trade often, diversify. So if something goes horribly wrong with one of these stocks, then your whole account doesn't blow up. Now, Honeywell I did yesterday, and I sold this straddle. So I sold a 125 put and 125 call, and I sold it for a little over $2 each. So I'm covered about $440 on the downside and the upside. So I've got no protection. So if this blows through 129 or blows below 121, then I'm going to get assigned the stock, or I'm going to be short the stock. I just don't see Honeywell doing that. And then I'll look at the chart here. So in the last, what is this? Last 2 months, and I'm taking a bit of a gamble, but the last 2 months has been around the 125 range, but it's been above 122 for sure. So I'm taking a bit of a risk. What I will do is, and you can see I put the order in already, I'll take this off at a 25% profit. So 25% of 441 is about $110. So once I make 110, I'm out. I'm not going to hold this to expiration. It's too risky to wrangle that much blood out of a stone. So I'll take the 25%, and then I have a probability of 80% of making $110 on this. Now, imagine that. If you went to Las Vegas and you could play blackjack with an 80% success rate, how often would you go? That's what I'm doing here. I'm doing this, and maybe it's not as fun as looking at cards, but I'm looking at numbers going up and down. All right, so I just placed Walmart. Market's about to close. I just placed Walmart, and I place. So this is what they call a jade lizard. A jade lizard, and there's different definitions, but a jade lizard is usually you sell a put and you sell a call. It's a strangle. So they're at different strikes, and you try to collect $1 in credit, and then you go up $1 above the call and strike and buy that, so that you're protected on the upside, but then you hope the stock stays between the strangle. Now, there wasn't enough credit here to do that, so what I had to do is narrow the strangle enough, so I collected about $1.40, and then the call cost the call cost about 46 cents. So I collected a little less than $1, but I have a 50-cent strike width here. So if this blows past 73, I've made and locked in about 50 cents profit. Is that right? That's right. So I've locked in 50 cents profit. If it goes below 72, then I will be assigned Walmart stock at $71 a share, which I'm ecstatic about owning Walmart at 71. And if I don't want to own Walmart at 71, I can roll forward the put to a later date and maybe try to lower the strike price to 71.5, collect more credit, and try to get assigned Walmart at a lower price. And so this is a great way of reducing your cost basis. Now, I looked at Whole Foods. This is an interesting stock because it's been trading in the range of, for about 6 months, between 32 and about 28. So I thought, okay, this is a great stock to maybe try to get a position in. So it's not very aggressive. Let's see here. And it's not going to get filled because it's past market close, but what I did here was I did another jade lizard of 29.5, 30, and 30.5, and I was trying to collect a 53-cent credit so that if it goes past 30.5, I will make 3-cent profit. But the mid price was 43, which means people who are offering to buy and sell this option were not offering me enough credit for me to be comfortable with the upside risk. So there would be a 7-cent upside risk. So that means if it blew past 30.5, I would have 7 cents in risk, which is not a lot, but I was not receiving a lot of credit. I would have received $43, and then with $7 of upside risk, it just didn't even make sense. So I thought, well, why not try to get a 53-cent credit there? And it did not work, and that's fine. So live to play another day. That's fine by me. All right, so GM. So this is a trade that's kind of gone wrong, but it's not horribly wrong. I did a jade lizard on this as well. So I sold a 37 put, 38 call, and then I bought a 38.5 call, which I later sold for some money, whatever was left in it. I think it was $16. So I was trying to capture whatever was left in there. Now this call, which expires in 2 weeks, I received $154 for it, and right now it's worth $6. So if I want to buy it back, I can buy it back for $6. And then this, which I just may buy this back. There's 2 weeks, and I don't want to have some upside risk without any protection on top. And then the put I sold for $178, but to buy it back, I would need to pay $342. So this stock is a loser right now. I've lost about 5% not including what I lost on the call that I bought. So I'm down about $100 on the stock, which is not too much of a big deal, but that's if I believe I received 212 credit. You can't see that here because that other option contract went away, but I received 212 credit. And then let me pull out my calculator here. So 212 credit, and then I received $16 from selling that. So 228 is my break even. I'm at 348. So you can see my loss there, which is not 348 minus 228. So I need to capture another $120 worth of value here for this to just break even. And of course there's commission costs. There were 3 contracts, so that was $6 in commission. So 3 options trades of 2 contracts each. So that was six contracts, $1 per contract. So not a big deal because I think GM is massively also undervalued, and my break even on that, let's see, I collected $1.60. No, I collected about $1. It was $1. Again, I closed that other contract, so that's not reflected in here. So I collected $1, and my break even would be $1 under 37. So that would be 36. So not bad. I might roll the put forward, but I believe the liquidity there for the GM options are not very good right now. So what I may just do is get assigned the stock and then sell some calls against it and collect some additional revenue that way, and making sure I don't sell a call during dividend week or ex-dividend week. So alright, so I believe I went through all my trades here. And let's look at Whole Foods real quick. Again, this was an interesting one. So it's just been hovering in this range for a long time. PE ratio 21.47, a bit high for my taste. But if I can sell the options against it and then get assigned around 20, 25, 24 when all is said and done, that would be good. And then I would collect a 2% dividend. I think that would be a good trade for me. All right. And I tried looking for some other stocks. I just wasn't very happy about what I saw out there. I saw Dr. Jim at Tasty Trade. He traded, what was it, FXE, but that's currency. I'm not going to trade currency. And some people don't care about the underlying. I care about the underlying because that's my risk mitigation. If I'm assigned the stock, I want to make sure, hey, I'm good with the stock. And I don't know anything about currency trading. I just don't want to get into it. It's not my thing. So if you're watching this and you see a stock here that you think I should look into, IBM. So I had this last week, and I was trying to find a good trade here. I just could not. I was trying to sell a 172, 175 strangle, collect $2. But then to buy the protection, I'd come out 163, and that's just not enough to cover the $2.50 width here. So I'm not going to do that. IBM has earnings coming out. The stock might go up in anticipation of earnings, and I'm sure as heck not going to trade it during earnings. Although let's see what I can do here. I'm not going to trade earnings. Yes, the option prices are more expensive. I would be protected on the upside. And then on the downside, I would get assigned the stock at about 169. That would be my break even. So, hey, I might look at this on Monday. So, it's an interesting one. All right, so that's the end of my show. I don't want to go too long. I hope this was helpful for people. If you guys want me to go into more basics, I can do that. But until next time, let me help you invest in your future.